Hi, my name is Billy Rabbit, and I want to welcome you to the Southside Blueprint. Today I'm joined with Mr. Justin Tiede and Emily Johnson of Waterstone Mortgage. So we want to talk a little bit about today. I know we've covered a couple of topics, and this is another episode that Emily's joined us, and I appreciate that. But today we wanted to dive a little bit deeper into some topics that aren't talked about frequently, I guess, in the mortgage or real estate space. So I know Justin's been preparing some questions, whatever. So Justin, you want to hit us up with the first question?
Sure. Yeah, starting off, one of the things that we see a lot is people putting 20% down on a house. So one of the myths is, would it be more beneficial to do a lower percentage down payment and then use that money elsewhere? So what's your opinion on that, Emily?
I think cash is capital. So if you can keep money in the bank and have it for emergencies or use it to upgrade the value of your home, I think that's the way to go. When I have clients come to me and they say, hey, I want to put 20% down, I'm like, okay, that's great, but let's take a look at the house. So if the house, needs some renovations, maybe we're going to put less money down and keep that in the bank so that you can then do the renovations on your own. Also, yes, your house is a way to invest money. However, it's not instant money that you can pull out if you are in an emergency. So maybe think about investing that money in something else, whether it's, the stock market or in a high interest savings account or something like that. Also, another myth is that mortgage insurance is very expensive. So you want to put 20% down to get out of that mortgage insurance. But when you go conventional, there's other ways to get out of that mortgage insurance. You can pay for the mortgage insurance up front, so that way it's rolled into your closing costs. So mortgage insurance could be costing you $80 a month, but to buy out of it and pay for it at the table is $6,000. So paying for it up front is a lot less than putting 20% down on a house. So again, to recap, cash is capital, in my opinion. Let's try to keep some of that money. That way you can use it to invest in something else, in case of emergencies or to, just enjoy your life.
Yeah. I mean, just chiming in on that. I mean, you hear this all the time, right? And even, a big misconception is that people think that they need 20% to buy a house, which is so crazy to me that we're still talking about that in 2025. But, I think that there's so many different options, right? I mean, and so many times when somebody goes into a house, it's never perfect. And, you're about to buy the most expensive thing probably in your life. And to think that you're going to buy that and not want to invest something into it, whether it's a new couch or changing the wall color or, adding something different, or whatever, and to not do that, it's just amazing. And it's like to really think that you're about to spend, hundreds of thousands of dollars on something and not want to improve it and to go and, deplete all your cash to do so, it's just crazy. And I think that's what gives a lot of buyers a lot of anxiety too, is that they think like, oh, well, I have all this money saved up and I've, lived very comfortably because I have this nest egg or this income here sitting here. But then I have to deplete it to go buy a house. It's almost like this anxiety-driven thing that happens, whatever. So yeah, I really like what you said about, using that cash or investing in other places where maybe you can pull it out in case of emergency and it can make you money and things like that. But I think that I was looking at a stat, which was kind of interesting, that it said that most middle income or median income, families in the United States, whatever, 30% of their, wealth is actually derived or part of their equity in their home. Mm-hmm. And so when you think about that, or you think about so many people that are, pretty much, considered the elite or the top 10% of earners or, people that have wealth in the United States, so much of that comes from real estate. And it's just so amazing to me. I think there was another stat that we were listening to the other day was that like almost 80% of people that are renting today, and I don't know exactly the numbers, but it was some astronomical amount of number of people that were renting today that were paying a lease that actually could afford to buy a house too, mm-hmm. which was mind blowing to me that would even be a number. So yeah, so I agree. I agree wholeheartedly that it's situational based, but also too, really think about it from a holistic approach of like what makes the most sense and what's going to be comfortable, because so many people, they buy a house and they realize that home ownership is not for them. And then they go right back into, and now they're selling a house a year in, 2 years in or whatever, the equity's not there. And all of a sudden now that great investment that everybody's been preaching to you, make this great investment, has now been a horrific investment. And so.
You know, and I think that's a good point too, because you guys both kind of highlighted the two sides of it, because there's people who don't have the 20% to put down, and then there's also people who do, but it's kind of figuring out for them, is that always a smartest move? So it depends on, kind of like you guys said, like, what are your other investment opportunities? How much would you like to keep in the bank for your rainy day fund? How much would you like to do to the house? So I think letting people know they have options is a big thing.
If you have 20% in the bank, you should go talk to a financial advisor and see what you can do with that money.
Right.
So
Yeah, or buy 2 houses, and then use one of them as an investment property, right? Yeah, help fund our kids to go through college. So yeah, I mean, so many different approaches to that, but you think of how many divorces happen in the United States, and I think the leading cause of divorce in the United States is over money, over finances, right? Mm-hmm. And so why not protect not necessarily your wealth, but also just your well-being, by having that extra money there. And I think there was a stat you were sharing something, Emily, when we were, not filming, but you had mentioned something about, paying the payments down and what that does. But if you have the extra cash and then maybe you get the next job, you get the promotion, you're making more money, you're able to put more money, you can always put more money down towards the house, towards the principal. I mean, there's nothing that says that you only have to pay that monthly payment every month.
Right. Just because your mortgage payment is $2,500 does not mean you have to pay that you have to, but it doesn't mean you can't pay more towards your house. So I was looking into it, and if you just make one extra full principal payment, so if you just do $2,500 towards the principal, you can pay your loan off faster. It cuts off, 4 to 5 years of your mortgage if you're doing that. So if you can budget it to where, like you said, if you got a promotion and you are getting a certain amount of raise, use some of that raise to go towards the principal. So not only are you paying down the loan faster, but you're also saving thousands on interest.
Yeah, no, absolutely. So, and I mean, it goes, with buying a house, with your wealth, for personal wealth and things like that, if you run a business and things like that, one of the guiding principles is that you always, pay yourself first, right? Or, so if you're going to do that and you have that money and hey, I can live comfortably off of this budget, there's nothing wrong with taking that extra money and then putting it down so you are paying down those payments or whatever to make you even more comfortable. So I guess that kind of alludes into, you had mentioned a question earlier too about, I guess, a 30-year fixed and a 15-year fixed. I didn't know what question you had with that.
Yeah, so, 30-year fixed seems to be kind of status quo at this point, what everybody goes to, and not everybody may know about the option of a 15-year fixed mortgage. So could you explain some instances where, a 15-year fixed mortgage might be more beneficial versus a 30-year?
Yeah, so it's really just affordability. What can you afford? Because using a 15-year fix, of course, is cutting the loan term in half. So while you are saving so much on interest because you're doing a 15-year versus a 30-year, your payments are increasing. So it's what can you afford per month? Right now, affordability is very, very tough. A lot of people are having a hard time qualifying for a 30-year fixed. So just because you get in with a 30-year does not mean you're locked into that. You can always refinance into a 15-year mortgage down the road. So we'll take a look to see what can you afford. But depending on, we kind of talked about this earlier, ARMs aren't super popular right now. And for those that don't know, an ARM is an adjustable rate mortgage. So it depends on where the market's at. With ARMs, you can do a 5-year ARM, a 7-year ARM, a 10-year ARM. So that's really good for people that, especially military or relocation. If you're only going to be at your job for 5 years, why not look at a 7-year ARM? That way you're giving yourself a little bit of a buffer. And that way, you're not going to be here for that long. You're going to sell that house before it's time for the interest rate to adjust.
And And what are the typical rate differences we see between, like a 30-year fixed or a 7-year ARM? Is there a big savings on interest?
I think it depends on where the current market is. There isn't like a set, it's a 1% difference.
Right.
It just kind of depends on where the market's at, to be honest.
But typically with a 15-year versus a 30-year, there's some type of savings, right?
Yes, correct. So, yeah, usually the interest rate is about a quarter, sometimes more, less.
Yeah, so... I mean, I think it goes into the whole approach of just there's never a one size fits all. And that's like the hardest thing I think to get over to a consumer sometimes about buying or selling a house, especially somebody that doesn't do it very often, is that there's so many options. There really are. There are so many options that they can utilize and take advantage of. And depending on the situation, like you said, Emily, is that, you really got to map it out to what makes the most sense, and really what you're willing to bear. I mean, that's the other thing. So, and I would assume that the rates, or the reason for why the rates are cheaper for the 15-year versus the 30 is that it's less risk for the bank.
You're investing more.
Yeah. So, I mean, and I think that's the other thing too, that we don't talk about enough, or people get so caught up in rates and what am I approved for and this and that, and I need to have pristine credit or whatever. Sure. The more that you have those boxes that are checked that make you a more qualified, or it's less risk, and that's the biggest thing that I think that everybody has to, at the end of the day, the bank, okay, the institution that's lending the money is taking a risk, okay? And they're trying their best to calculate how much risk, right? And that's the whole point of a credit score, is to pretty much calculate how much risk, or how financially, savvy are you, or, how responsible have you been, with your finances. And it grades us on these things or whatever. But then based on how much money you have saved, the other thing too, that, going back to the whole 20% thing, is that sometimes I have found that, based on the loan type or the situation, the bank wants reserves. So they might not necessarily want you to deplete all those, because they want to show that you have a couple months, gosh forbid you go into hard times, you have a few months to make sure that mortgage is paid. And so, I mean, there's just so many different things that go into finding the right program or product or whatever for them. So
yeah, a lot of people don't understand why rates are so much higher if you purchase a second home or an investment property. And, think about this. If you have a primary residence and then you have a second home over in Ocean City, if things get tough, which one are you paying for?
Right.
You're going to pay for your primary residence. So that's why interest rates are less on primary residence than second home and investment property, because those are riskier. You're going to be making sure your primary residence is covered before those other properties.
Same thing when you're buying something in an LLC, I mean, when you're buying an asset with an LLC, I mean, if you go to buy a vehicle in an LLC, you're going to pay typically more in interest rate. There's certainly much more risk. Whole design around an LLC or having a second home or whatever is that you're putting less risk on yourself or whatever, and you're putting more risk on the institution that's financing it. So
yeah, definitely.
Of course. Yeah. So another thing we have, there's a premise, and you guys may have heard this before. The saying goes, it's marry the house, date the rate. So
love that saying, man.
Yeah.
Oh, that's what we were all TikToking to for a little while,
Right.
Yeah.
Right. So basically, what that means is find the house you really like, and then, get into it when it's available. And then, the rate may not change. If it were to go down, you can refinance. Now, what's your opinion on people getting into homes with, the hope that a couple years from now they can refinance? You think they should bank on that, or how?
Listen, no one can predict the market. And if they tell you that they can predict the market and you can refinance in a year,
date the rate.
No,
buy the house.
Don't do it. You need to make sure you can't overextend yourself, and you need to make sure that you can afford the current payment. What if things get worse? What if you have to keep paying this higher payment that you are dating the rate for longer because it's taking longer for the market to adjust? You need to make sure that you can afford it in tough times. So it's really situational based per person. And also, a lot of people are like, oh, you just have to make 6 payments and then you can refinance. No, that's not how it works. It needs to make sense financially for the cost of refinancing. Make sure that you can recoup those costs in a decent amount of time. So long story short, my answer is it's based on what you are comfortable with affordability wise.
Right. So I think it's safe to say that, the date the rate thing is very loose advice, because
it's a marketing tactic.
Right.
It screams, pay my commission check. That's what it screams. Yes. My kids need to eat. Yeah. That's what it screams. But I mean, I think with that, the idea behind it makes sense. I get the understanding of that. I mean, I think the delivery of that whole date the rate, buy the house, type of thing was a little, I don't know, it was a little self-fulfilling. But I think the whole principle behind this, whatever, when we were talking about this earlier too, was that, at the end of the day, if interest rates, let's say you're sitting on the sidelines right now and you want to buy a house, and you're sitting on the sidelines and you're hoping and you're praying that the interest rates for mortgages are going to come down, that's great, okay? But the idea is that typically if you look over the last 30 years, okay, in housing, historically, home prices have always continued to grow up. I think we were looking at it earlier. In the last 30 years in Maryland, there was like 4 or 5 years where there was depreciation of home values, whatever, and that was right after 2008. Okay? I mean, you look at this or whatever, typically buying a house in equity, and I think, Emily said earlier, yes, you can't pull it out right away, okay? And there are different things like home equity lines of credit and different things like that, yes, you can utilize your home equity line of credit. Personally, if you're making the right business, right financial decision of what you're using that equity for. But, at the end of the day, if rates don't come down, what did you win? You didn't win anything. I mean, now you're paying more of a house, whatever. And I know Neil has this infographic on this, which I thought was pretty neat. It's like, if you waited 5 years for the interest rates to drop down some, 0.5% or 1% or whatever, you've actually lost money because of the fact that appreciation has killed you, you know? So, yeah, I mean, I think the whole premise of this is that, if you like the house and you can afford it and you're comfortable with buying the house and it makes sense for you financially of what your long-term goals are, then the best time to buy is right now.
Right.
You know what I mean? Because you can always refinance if the rates go down lower.
Yeah, no, and I agree with you. I think it is definitely important to, when you're getting into a house, to always be comfortable with the situation you're getting yourself into. Because I like to take kind of like a worst case scenario mindset where if this was the rate I'd be paying, would I be comfortable with this? And if I wasn't, then you should never overextend yourself. That's what I'm getting at.
No, it's that's the biggest challenge for people is that they buy a house because of a status thing or because that's the thing that they were told to do or whatever. And for some people, it just does not make sense to rent or to buy. I mean, it just does not. They are better off renting. They want to move. They want to do different things. They want to be closer to an area where it just wouldn't make sense financially to buy, and it just makes more sense to rent, which is perfectly fine. They don't want to cut the grass. They don't want to change the air filter. They don't want to do those things. Great, rents. I mean, that makes a lot of sense, whatever. But the crazy thing is when we talk to somebody, and it happens almost on a weekly basis, where they are certainly financially able to buy, and there's some myth that they've created or something that they saw on Instagram or TikTok or something or whatever that is preventing them from wanting to talk to a lender. And to me, it's just so crazy.
Yeah.
So what other questions do you have for us there, Tata?
So let's see how this one goes. So I have one question I have is, a lot of people are holding off right now because they think that we're in a bubble right now.
The bubble, it's about to pop.
A bubble that's about to pop. So, and a lot of people, or not a lot of people, some people refer back to what happened in 2000, the early 2000s. And, a lot
when
of
you
that.
were like 12?
No,
we both
he
were
was
12?
he was like 5. Oh, come on, that hurts. That hurts. All right. Wow. All right, this is done. We're done.
I was more like 7 or 8, but I don't have firsthand experience, but I've heard.
Billy, you were in like college, right?
Oh yeah. Thanks. Wow, this really hurts. Back in the golden days in 2008. When the meteor hit and the dinosaurs died.
Right. Yeah.
That's what all real estate
Did you have
agents
color
refer to.
TV back then?
Yeah, no, certainly didn't even have internet.
Oh wow.
Dial up.
Yeah.
Okay, back to your question. Sorry.
No, and so some people think this is a housing bubble and a similar situation to what happened in the early 2000s might happen again, but a lot of that was caused by poor lending practices. So
people went to jail.
Yeah.
People went to jail.
Of course.
It was from all parties. I mean, it was, you can go back and do any research on that. And there was lenders that did bad things. There was real estate agents that did bad things. There was appraisers and home builders that did bad things. I mean, we did it to ourselves. I mean, that's really what happened to the industry, did it to themselves or whatever. But I think I know where you're going with this or whatever is, are we in a bubble today? Right. I mean, and who knows? I mean, at the end of the day, I mean, there's nothing that happens. I mean, and Emily, you could speak to this, but the guidelines continue to get stricter, not easier. I mean, you can look at the guidelines for a USDA loan. 5 years ago, they were much easier to get somebody approved for a USDA loan than it is today. Yeah. And so everything has become stricter or whatever, because again, at the end of the day, when lenders are doing the right thing and making good, sound financial decisions that are ethical, they're going to protect their investment, right? They want to make sure that if I'm loaning money to somebody, that it's going to make sense financially and that they're going to repay it. And, we're doing our due diligence on that. But, I mean, I don't know. I mean, unfortunately, we had a pandemic, the whole world shut down. interest rates drop down, to, lows that we've never, ever seen before. And yeah, I mean, sure, we've seen, you saw the home values skyrocket in 2021, and we saw a little bit of it in 2020 and 2022. But I mean, everything's kind of normalized. I mean, right now what we're experiencing a market correction and probably much needed. I know that's probably not what many real estate agents or professionals want to hear or whatever, but this is probably much needed because the affordability of housing was getting out of control. I mean, to think that you can go and buy your first home and have to pay $3,000 a month, it's crazy. But on the flip side of it too, we're also paying an astronomical amount for a carton of eggs. So everything, I mean, it's all cyclical, right? I mean, everything is related. And so, I mean, it unfortunately we're there, but I would say that the people that are buying homes today are approved to it. Yes. Could some clean up some buying habits? Yeah, sure. I mean, I'm sure you probably see lots of things, Emily, on, when you're, pre-approving somebody, there's probably a lot of spend or money that goes out.
DoorDash, Amazon, Marshalls, TJ Maxx. Am I talking about myself or am I talking about Brian?
Yeah. You young kids. But no, I mean, it happens. I mean, we're in a world where literally I can click a button and toothpaste gets delivered to my house. I mean, and now with, some of them within hours. I mean, so,
It's pretty convenient.
Yeah, exactly.
I did DoorDash. I'm not going to
expose yourself.
No.
Yeah. But I mean, that's just the world that we live in. And so, I mean, I think what we're going to have to do is personally, I think we're going to have to go through a change. I mean, with our buying habits. I mean, the whole day of sitting at home with a mask on or whatever through the whole COVID thing and clicking a button and something get delivered the next day. I think we're going to have to just correct a lot of our buying habits. And I think you're seeing a lot of that now. I mean, I think that's what the market is right now, is why people aren't jumping in and buying a house right this second, because there's a lot of uncertainty and there's a lot of trying to figure it out. Are we in a bubble? Are we not in a bubble? Is this a good financial decision? Am I a home buyer? Am I a homeowner? So I don't know. I mean, I don't know what you guys are seeing, but I mean, that's my 2 cents on this whole thing.
I think it's completely different from 2008. Like you said, the entire lending process is completely different. Like back then, people would falsify documents to make it seem like someone could get pre-approved. They barely required any documents back then. They didn't do a verification of employment. They just said, oh, Billy filled out his application. He says he makes $100,000 a year. Cool. No problem. He's approved. Versus now we go through so many different layers of making sure someone can actually repay their mortgage, because we don't want you to foreclose on a house. We don't want you to go into bankruptcy or anything like that. So we're really doing our due diligence to make sure people can afford houses. But not only that, just in general, the economy is a lot different than it was in 2008. Job markets are great. The stock market's doing well. All these different things versus what it was in 2008. So all the people that are sitting on their couch, posting on social media, I can't wait for the market to crash. I'm sorry, but it's not going to crash. Things are doing well.
Yeah. And I mean, it gets to a point too where people are just, we're so influenced by what we watch on social media and things like that. And then unfortunately, it's amazing how many times we talk to somebody and they still think interest rates are 8% plus.
Yeah. Stop listening to your uncle who hasn't bought a house. Talk to the professionals.
I will say this too. I feel like as a real estate professional, real estate agent that's servicing clients on a regular basis, I feel like I've had to get more involved in every aspect of the business than I ever have, especially with the market downturn, right? To a point that I've had more conversations with buyer clients or, people that are buying or whatever about making sure that they understand their finances. Mm-hmm. And I feel like that's such a huge opportunity or whatever, because, they go on and they click an ad or they get targeted with a social media ad or something like that. And they click on something and they see, and it just feels like there is a difference between lenders. I mean, there are. I mean, there's difference in rates and difference in programs, difference in charges and things like that. I mean, if you were talking to a buyer that was buying a house, I mean, what should they be looking for when they're talking to like a mortgage professional? What are some of the things that are like, hey, you need to really be aware of this?
Yeah. A big one that I can think of right off the top of my head is location. I had someone that came to me, they got pre-approved with an online lender in Charles County, and they were buying in Charles County. Lender was online. The lender didn't know about the school tax in Charles County.
Sure. Yeah.
So they are under contract on a house and they get their loan estimate after the title company disclosed the property tax bill. they could no longer afford this house.
Yeah.
So that's the biggest thing is who you're working with, where are they located, so they are knowledgeable about the market and things like that. But also, what programs do they have available? And what do those programs, yes, they're offering you a grant, but how is that impacting you on your loan estimate? Are they charging you a higher rate because you're getting a grant? Or is it actually truly a grant? So take a look at that, and then, yeah. That's my biggest thing. Yeah,
and I hate to pick on lenders or whatever, but I feel like there's I don't know. It's tough. You guys, it's tough, and I'm just gonna. It's tough for you guys. I mean, because a lot of times you guys are being judged on things that you're being compared against. I would say that loan officers get shopped much more than real estate agents, for 100%. Sure. And so at the end of the day, it's up to us when we go out or we meet with a client or whatever. Typically, if I go out and meet with a client, we've already built a relationship. We have rapport. There's some trust established, things like that. With you all are being referred to by, from a real estate professional that you work with, or by, they find you online, or, maybe you helped out somebody that they know or whatever. And then all of a sudden, whatever, it becomes a numbers game, right? It becomes black and white of, hey, what's this, what's that? And the amount that I go and I look at like an estimate sheet, I look at like a fee sheet or a breakdown, and it's like they blatantly have not included taxes, or they blatantly have reduced the amount of, settlement fees just to make their, it's just so crazy to me. I mean, it really is. And it's upsetting because the average consumer, they're trusting the loan professional to make sure that they're being ethical, or they're being, honest and open or whatever, and they're being, transparent about these things, but it's not. And it's because they're just trying to win the deal or whatever. Yeah. And I think, there was one, I think that you had shared with us that, they had given an estimate, or there was this, and then all of a sudden they got under contract and they sent, I guess, the initial CD out, and it was like $10,000 more or something. Mm-hmm. I mean, it's just so mind blowing or whatever. So, I mean, it's so important of when you are selecting your team and you're going through this whole process of making sure that you're really doing your homework or whatever, and that you're comfortable and that you can trust those people.
Yeah. Your real estate agent is referring, these loan officers and these title companies because they've taken the time to build a relationship and vet these people. They're not doing it because they're getting, something on the back end. That's not why. It's because they know and they trust these people, and they're going to have your best interest in mind. So cool. You saw a rate online for, whatever it may be, but that's not accurate, and that person's not going to have your best interest, and they're not going to be honest. Bait and switch is a real thing. So, you get your loan estimate and your rate's this and your cash to close is this, but then once you get under contract, they disclose everything to you. It's completely different.
Sure.
So
no, and then it's challenging because then at that point you're already under contract, right?
Yeah.
And then you feel like I can't do anything. You can absolutely find a new mortgage professional.
Just because you speak to somebody initially does not mean you're stuck and locked in with using them like it is with a real estate agent. And a lot of people are like, what? That's not fair. No, it is fair, because unfortunately there are the bad guys in my industry who will lie until they're blue in the face, and then you cannot be locked into that.
Yeah. I mean, it's just crazy. And then even for the real estate, I mean, at the end of the day, every agreement has a way to terminate it. I mean, there's just no way to do it. So, but, it's just amazing to me, some of these things that I see or whatever, or the, origination fees are through the roof, or they're charging a whole bunch of points or whatever. And I mean, look, there's some websites or some lenders out there that have gotten in a lot of trouble for this. And, they now have to post things on their website, to be transparent about it, because they got in trouble for it. They were being, the deception is real. So
read the small print.
Yeah. No, and everything is not apples to apples. I mean, like that's one of the toughest things. I helped my sister-in-law purchase a house recently, and I helped her go through the activity of talking to different lenders and looking at different things. And I will say it was very challenging. It was very challenging, from lenders to lenders that I trust and that I work with on a regular basis, but just making sure that everything was aligned as close as you can or whatever, to try to see what was the best option. And it's tough.
Yeah. And speaking of apples to apples, like interest rates change every day and sometimes multiple times a day. So say you go to lender A on Monday, then you go to lender B on Wednesday, and then you go to lender B on Friday, or lender C on Friday. And then you're trying to compare those estimates. That's not apples to apples. That's apples to oranges to bananas, because it's 3 different days. So a lot can change within those 3 days. So if you're trying to shop and compare, I definitely recommend trying to do it all on the same day. that would just be like interest rate and points, but the origination fees, those you can compare any day because they shouldn't change.
Right. No. And so when do rates get, I guess, announced? I mean, do you guys is there a certain time of day that you guys get your like rates for the day?
Yeah, 10:30 in the morning.
10:30.
And we're based in Wisconsin, so that's part of the reason. But usually around 10:30.
10:30. So at that point in time, I mean, if you were shopping rates or you were looking for different things, and again, I mean, rates is certainly not the end all be all. I mean, at the end of the day, like you said, different programs, different things like that. But if you were looking for that or whatever, or at least making sure that whatever offer you have is at least competitive, right? I mean, I think it's important or whatever that you are, like you said, comparing same day, making sure that it is apples to apples.
Also, say you're just getting pre-approved and you're comparing rates, okay? So that could be the beginning of October, but you don't get under contract on a house until mid-November. Things could completely change during that time. So it doesn't hurt to do your due diligence, but definitely lean on your real estate agent too to help guide you, because for the average consumer who's a first-time home buyer, looking at 3 different loan estimates is so overwhelming. It's a lot to digest. So lean on your real estate agent and they should be able to help and guide you, help you to understand what the difference is between the 3.
Yeah, no, absolutely. So, Justin, I know you have somebody that's in the process of buying a house or whatever. I mean, what things have you had to clear up or clean up with maybe some myths or some things that they, had the wrong perception about?
Yeah, so I kind of just went over with them and explained some of the costs they could expect, because not everybody knows you have your taxes, your all the fees included with that. Kind of going over the closing cost fees and what he could be expecting with that. But then another thing was getting closing assistance. So with this particular one, he was able to get in for lower than he originally expected. So kind of explaining all the fees, but another on the other side, showing him how there is options to get in for little to no money, relatively speaking.
Yeah, I mean, we've had a couple buyers here recently. I mean, one went to closing with $34. The other one went to closing, I think, with $100 and some.
Yeah.
I mean, these are real things, and these aren't like high price range houses either. I mean, these are, right in that below the median price or whatever within the community that they're buying in. And so, yeah, I mean, there's just so much that goes into it. But again, it's just about the communication, having a good team surrounded around yourself, making sure that a lot of these myths that people have, I mean, ask questions. I mean, there are so many real estate agents out there. You can ask a question, and if you don't feel like you're getting good advice, ask another one. There's, I think, like 1,200 of them in Southern Maryland. I mean, so you got plenty of people to ask questions to. There's no shortage of lenders, too. I mean, so ask questions, get answered. And look, I mean, shop. I mean, interview. I mean, just like a job, I mean, you don't typically hire your first candidate. Talk to people. And at the end of the day, it's going to come down to who you trust, who do you enjoy working with. Because ultimately, this could be a month process. It could be a 3 months or 3 year process. Depends on the situation. So, I mean, liking the person is always like a big thing, right? So, but well, cool. So, well, this is very good. You guys have anything else to add?
Nope.
No, all good.
Thanks for having
very
me.
Very good. No, absolutely. So, well, Emily, thank you so much for joining us again, and hopefully, this was some good information, some peeling the layers back a little bit of some things that are kind of not necessarily talked about all the time. So, but check out, make sure that you're looking out the rest of our podcasts. And if you have any information, you can find our contact information below. Thank you.
Thank you.